If a single stock has grown to dominate your portfolio, you already know the risk. But most people stay stuck because they're afraid of the tax hit from selling. Today, we're walking through the capital gains math for 2026, including the strategies that let you reduce your risk gradually, tax efficiently, and without giving up your financial future to protect a gain that's already been made.
Welcome to Leibel on Fire with Amazon best-selling author and Yields for You portfolio manager, Leibel Sternbach. Leibel on Fire is supported by our ETFs, Yields for You Strategy A and Relative Strength Manage Volatility. Our mission is to help 1 million people retire with financial security. Now, the financial independence and retirement show dedicated to helping you build the life of your dreams as fast as possible with as little stress as possible. It's Leibel on Fire.
With me is Leibel Sternbach. I'm Freddie Bell. Welcome to Leibel on Fire. And I'm wondering, Leibel, how concentrated is too concentrated? And at what point does a single stock become a genuine threat, a pain in your backside to your retirement?
So that is a really great question. And I'm going to preface it by saying that the key to wealth is concentration, right? So when you look at Warren Buffett, right, his strategy is to concentrate, right? He holds a very small number of companies and he pours a whole lot of money into them. And that really is the key to success, right? The more that you diversify, the more you are reducing and watering down your returns. And the reason why, John Bogle, Vanguard, right, advocated doing this and everyone talks about diversification is because the age of being able to, pick stocks, well, who knows what's going to be the next big thing. And, you're not spending all this time trying to figure it out. You're not Warren Buffett who can go into companies and figure out what the next big thing is, or even figure out if a company, is a company worth putting all your eggs in one basket. Having said that, though, I really think that there's a balancing act that happens between diversification of spreading, your money across different baskets and different eggs versus concentrating, which is having fewer eggs in a smaller number of baskets. And so you're always playing this juggling act. We've got our ETF, RSMV, the Relative Strength Manage Volatility Strategy, which is what it does, right? This is a full-time job of managing that concentration going up and down and making sure that we're taking on the least amount of risk to get the most amount of return, so that we're concentrating when the markets are in our favor and diversifying when they're not. Having said all of this, right, the question becomes, right, when is something too much? And oftentimes this happens because we're working for a company and we have insider information into that company, or we very much believe in the company that we're working for, and we get granted stocks in that company at great prices. And you should take advantage of that, right? Because if the company is successful, you will be successful. And I have seen people become, millionaires as a result of that. However, at some point, you need to start diversifying yourself away from it, or you need to figure out how to deal with all the capital gains that you have built into this. Because when you have, 5 or 10% of your portfolio in one company, that's a company goes, bankrupt or gets cut in half. Well, okay, you can deal with that. That's a, 5% loss or 10% loss. When it's 20% of your portfolio or 50% of your portfolio and that valuation gets cut, the question is, can you survive that, right? And just the other day, I had someone come to me and they own a stock that is currently getting really beaten up. I think it has been down every single day. I talked to him 2 weeks ago, 3 weeks ago. The stock has been down every single day since then. And we're not talking about, single digits. It's every day it's going down by 5 or 10%. Because it is at risk for AI, right? A paradigm shift came along and everyone's saying, well, this company is based on an old world principle, right? The railroads, and railroads are going away. Everyone's got personal cars. And so therefore, right, we're horses within personal cars, right? And therefore this company's valuation is going to get cut by a significant amount. And If your retirement is tied up in it, which this person's retirement is tied up in it, you got to figure something out, because you've now tied your financial security for the rest of your life to a company that may or may not have a strategy. And it's not, even if they have a strategy, take IBM, right? IBM had a strategy, right? They were the technologists for the last 120 years, except at some point they missed the boat on personal computers. They missed the boat on what the future was. They bet that it was going to be hardware, not software. They bet it was going to be enterprise and not individuals. They were like, the consumer market is going to be tiny, right? Well, now we all got supercomputers in our pocket. ChatGPT, right? It's 800 million users who are not enterprise users. They are not businesses primarily. And they missed the boat on that, and they're still playing catch up 30 years later. You gotta evaluate, right? What is too much? It's the amount that if it went to zero would affect your financial security in a way that you are not comfortable with.
Forgive this question. Is there really a way for a retiree to sell shares at a lower rate, maybe even zero Leibel, that most people don't know about? And then position that with, what are the actual 2026 capital gains tax rates?
Yeah. So let's talk about the big question, right? How do we diversify ourselves in a way that doesn't trigger those capital gains? And so that's question number one. And question number two is, if we don't have a choice of those capital gains, right, how can we protect ourselves? Or maybe we do believe in the company, we just want to protect our downside, so that if the company fumbles the ball, right, we are not out our entire retirement savings. And I'm going to give you the answer, right? And go look this up, right? Mark Cuban talks about this all the time. He built an internet radio station, right? He got a whole bunch of users, and dot-com boom happened, and Yahoo came along and purchased his company. They purchased him and they gave him stocks. Him and all his partners, they gave stocks. The market was at all-time high, and he talks about this, that he was worried about that. He was worried about what happens if it goes down. I think it was JP Morgan, right, who was his new financial advisor, came along and told him, right, hey, we should probably protect your downside. And they, at the time, the only way to do this really at any kind of scale was to do this with an investment bank like JP Morgan or Merrill Lynch or Goldman Sachs, those big investment banks. They can do these things called swaps, which are these institutional option contracts where they provided the right to sell those stocks at the current price if the market dropped by, 10, 20, 30%. And guess what? To Yahoo, right? Yahoo stocks dropped, and Mark Cuban got his $3 billion, and his partners lost their money. They didn't lose all of it, but they lost a significant amount of money because he hedged his downside, right? And that is, that same strategy is something that you can do for yourself, right? And, at Yields for You, this is what we do for people who have those concentrated stocks positions. Now, we aren't experts in doing that hedging. We understand it, but that requires really a dedicated team who's going out there getting these option contracts, and you got to do both sides because it's expensive, and you can't just pay the insurance premiums. You just pay the insurance premiums without offsetting the costs. You're going to go bankrupt and buy it with the protection. And so there are strategies for doing this. There are teams that this is all they do, and this is what we connect our clients with, is the ability to do that.
So can you unpack that for us a little bit? So what are 2 or 3 of the most realistic ways that we can unwind from a concentrated position in a tax efficient way over time?
Yeah, so the first way that we can do it, right, is tax loss harvesting. So tax loss harvesting, something we've talked about a lot on the show, which is, you, instead of owning, the S&P 500 as an ETF or a mutual fund, what we do is we hold individual holdings of the S&P 500. And the example I like to give is, Coke and Pepsi, right? They're basically exactly the same thing. Whatever makes Coke go down is going to make Pepsi go down in value, right? Whatever makes them recover is probably going to be the same thing. And so what we do is we hold Coke. Coke goes down, market's down 5, 10%, 20%. We sell Coke at that loss, and then we purchase Pepsi and ride the recovery up, right? We get to participate in that market recovery, so we don't actually lose any money. However, we get to go to the IRS and we get to say, hey, Mr. IRS, I made a very bad trade and I got a loss here. And we get to use that to offset our gains. So now we can sell, $20,000, $50,000, whatever that loss is on that concentrated position that we have. So that's strategy number one. Strategy number 2 is, let's say we're really worried about, the market coming out from under our position. We're worried about this thing having a 50% loss. Well, we can go and we can get options that say that give us the right to sell the position if it goes down, at a, negative 10 or negative 20% or negative 50%. So that whatever that protection level that we need, we're able to sell it. Now, those option contracts are going to be expensive, especially if the market is volatile, especially if our position's getting beaten up. But what we can do is we can offset some of that by selling call options on the upside. So we're generating income. You look up covered call strategies. There's a whole lot of things out there. When you combine covered call with selling puts, or buying puts and selling covered calls, you end up with this strategy that gives you this trading window where you get to participate in the upside, but it generates active losses that you can use to offset the downside and slowly sell down your position. In addition, it gives you protection so that if the market the rug gets pulled out from under these positions, well, guess what? You can sell that. You will have a tax consequence for selling it, but at least you didn't lose, 80% of your money or 100% of your money, because remember, stocks can go to zero where, index funds is kind of hard for it to go to zero.
Interesting. So, my kids just say, just hold it for the step up in basis. When is it actually smart planning and when is it just procrastination?
So holding it for the step up in basis points, you got to ask yourself a few questions. One, do you need to live off of this money? And what percentage of this money do you need in order to live off of it? And depending on those numbers will determine whether it makes sense to hold for the step up in basis points. You also got to answer the question, do you think this company is going to be around by the time you die in 20, 30, 40 years? And will their valuation have increased or decreased? Will they be able to stay relevant? Which means, right, you are betting on a company you have no control over, that their leadership over the next 30, 40 years is going to remain relevant, is going to make all the right decisions, and is going to be able to continue increasing their stock price. Because it's not only that they're doing all the right things, but it is that they are communicating it correctly to Wall Street. Because if they don't communicate it correctly to Wall Street, right, it doesn't help. And that there isn't going to be a paradigm shift that comes along that completely upsets their entire business model, which is almost certainly going to happen, right? Like even defense contractors, which were considered to be kind of like the most stable thing on the planet, because it's hard to get defense contracts. It takes a lot of know-how to build these weapons. Guess what? We got Palantir that came along, right, and building AI weapons, and they started, just a few years ago, and somehow they're getting, multi-billion-dollar defense contracts, and they're pushing out Boeing, right? Who would have thought that Boeing would lose contracts to a startup?
You never know. You never know. So finally, we're just about out of time, but I'm wondering if somebody is sitting on a concentrated position based on what you've told us right now, and they haven't done anything about it, is there anything that they can do actively this week to take care of that position?
So what they should do is they should reach out to us and we should have a conversation, because in addition to what I talked about with the options, there's also exchange funds, which is another possibility. There's tax loss harvesting, there's charitable giving, right? So depending really on what their wishes are and whether they want that step up in basis points, whether they want to live off of it, getting a security line as a credit. There's all kinds of strategies that we can use to help minimize the issues associated with the concentrated stock positions and give them the income they need in retirement, give them the security they need in retirement, and do it in a way that is as tax efficient as possible.
Makes a lot of sense. He's Leibel Sternbach. And what we've learned today is that concentrated positions feel safe because they've worked. But in retirement, a single bad year in one stock can do permanent damage that no recovery ever undoes. The 2026 capital gains rates, the gradual sales strategy, and the charitable giving tools all give you a real path to reducing that risk. But they only work if you use them. So the most important thing you can do right now is run the numbers and stop letting the tax tail stop you from protecting everything that you've built.
If you would like to see how the Yields for You team can help you get off the Wall Street roller coaster and save you money on taxes so you can live the life of your dreams, book an appointment online at yieldsforyou.com or call 410-914-4894.
Yields for You is a registered investment advisor in the state of New York and only transacts business in states where the firm is properly registered or is excluded or exempted from registration requirements. Registration as an investment advisor is not an endorsement. Information presented on this program is believed to be factual and up to date, but we do not guarantee its accuracy, and it should not be regarded as a complete analysis of the subjects discussed. Discussion should not be construed as an offer to buy or sell or solicitation of any offer to buy or sell the investments mentioned. Annuity guarantees are subject to the claims paying ability of the issuing insurance company. Content should not be viewed as legal or tax advice. Always consult an attorney or tax professional regarding your specific legal or tax situation.